Today, the worst of both worlds. Hello again, it's Martin North from Digital Finance Analytics, where I notice post covering finance and problem news with a distinctively Australian flavour. It's Friday afternoon, and Tarek Brooker is with me once again. Hi Tarek, how are you going?
Not too bad, Martin. How are you?
I'm all right. I'm listening to the storms running around the hills outside and thinking a very good analogy for what's going on, economically speaking.
Well, there's certainly a lot happening all around the world, from Chinese property having its issues to the whole debate in America over the various things with the debt ceiling and stimulus, and it's all very, very interesting outside.
Yeah, and then Gladys just popped out and said she's going to leave as well, just to add a little bit of local spice and flavour as well.
Oh well, you got to keep it interesting, don't you?
You do. Now I know you've got some slides, so let's start with those, because I think it'll be a good way to get into the broader conversation. So,
all right. Well, today I've decided to call this the worst of both worlds, which is a sort of take on the fact that we've got this strange thing at the moment where if you're wealthy, if you're an asset holder of some regard, chances are things are looking pretty good for you, but the problem is that masks the issues that other people are facing in terms of, the way the broader economy is still very uncertain, and also the fact that inflation is starting to become a major issue, not just here in Australia, but around the world.
Yeah, and it's worth saying, Tarek, isn't it, that the inflationary pressures are building. I mean, Powell the other day said that, the transitory, temporary inflation could go on for a bit longer. And I suppose the question is, at what point does temporary become permanent?
Well, exactly. And, I think we'll get into that a bit today. So I'll just kick on from here. I quite like this little cartoon, Margin Call 2021. Okay, now this is leads into just what we were talking about in terms of the way things are, given the differences between demographics, because services spending globally, and in particular in the West, where things haven't gone back to normal in terms of the virus in a lot of different nations, things still haven't returned to normal in terms of the balance between goods spending and services spending. And this is why we're seeing all these huge supply chain issues at the moment, because, well, not the sole reason, but it is a key driver. And basically what happens is when you try to jam through an extra 15 or 20% worth of goods spending, the goods just aren't there. We've become accustomed to things rising at roughly trend, and that's what our supply chains are prepared for. And it also shows that when things do finally revert to trend, that we are going to see a significant drop in spending on goods, and that could have some fairly serious economic consequences both around the world and here in Australia.
And I'm assuming, Tarek, because that's a US data set, but that does seem to me to be mirroring what's going on in other places as well. So it's a pretty consistent global pattern, which is why the supply chain disruptions are so significant.
It is indeed. I mean, I think we can expect in the long term for things like retail sales to revert toward their long-term trend. I mean, even though that may take some time, considering, things aren't exactly back to normal in a lot of different places, particularly here in Australia. But eventually, one would imagine it will occur. And I mean, even if it ends up above trend, it's still quite a long way to fall to go back to normal. So, there is quite a lot of potential downside there. Now, this is actually a perfect illustration of that potential downside. This is US real personal income, which is inflation adjusted. And basically, as you can see, it's gone pretty much nowhere since the end of 2019 and the start of 2020. And this is despite the fact that the US government has thrown the largest non-wartime stimulus at the economy in history. And that, I think, really just goes to show how there could be a really significant gap between what ends up being supplied by manufacturers and wholesalers and what might end up being there in terms of demand in the long term, once the so-called fiscal cliff does pass through the economy.
Yeah, and of course, more support is being withdrawn. And, the confidence in the US and elsewhere is quite weak as well. So you perhaps think people may spend a bit less.
Well, there was one analysis yesterday. I don't believe I remember who it was from. It might have even been from a Fed board member. but they said that the withdrawal of stimulus, the fiscal cliff as they're calling it in the US, was equivalent to 250 basis points worth of rate hikes from the Fed. So when you put together the impact of the withdrawal of fiscal stimulus together with the impact of inflation, and also the impact of inflation on consumer confidence, which is cratered in the US, it really does create, a fairly concerning picture for what may lay ahead. Now, this is one I thought was quite interesting because it does sort of lend a bit of credence to the idea of inflation being a bit more protracted, because we have seen a lot of excess, so-called excess retirements. Now, in the US, we've seen an additional almost 2 million people retire over what was expected based on previous trends. Now, one of the reasons this is maybe occurring has been theorized by Wall Street is basically just that a lot of boomers have had quite a good run with asset prices over the last 18 months. So they can afford to retire. Their stock portfolios, their investment properties have all gone through the absolute roof. So they can afford to get to leave the labor force. And while this is still a sort of an indicator and a potential driver that's still in its infancy, it is something worth watching as to see if we do see some form of wage inflation become entrenched if this trend continues.
Absolutely, and it's interesting because I've seen similar data here in my surveys too, that some of those more affluent older people are now moving into retirement because they've got that sort of nest egg that's been built up, particularly with stock market performance as well as property performance. And I should just add that we have the most humongous storm going on at the moment, so if you hear some funny noises in the background, blame the weather.
No worries, mate. No, it's interesting. I mean, like here in Australia, for most of the last 15 or 20 years, if you've lived in a popular major capital like Sydney or Melbourne, chances are your property has made more money than the median household in over that time period. So, it's not really, I mean, for a lot of people, they're just saying, well, why should I work? My house earned 150 grand last year, and I don't have to pay any tax on that. All right. Well, this is an interesting one. Basically, U.S. rents are absolutely going to the moon. Now, part of that is based. excuse me. Part of that is from the base effect, because obviously we had that period between March 2020 and basically the start of 2021 where you couldn't basically really raise rents because of things like eviction moratoriums, and basically in a lot of places rents were falling, to be completely frank. But now that things are returning to normal, rents are rising at a meteoric pace in the US. And part of the problem with the CPI in the US is it doesn't measure rents in the way you'd think. Somewhere around about 2/3 is based on owners estimating how much their property could be rented for, not how much someone is actually paying for rent. So that creates a really challenging component in terms of the CPI, because basically you're left with this scenario whereby in reality rents are going through the roof, but you've got Powell and you've got Yellen saying, "Oh no," but I'll look at the CPI, things aren't so bad. So it creates these really, really challenging political moments for policymakers.
Yeah, right. And once again, the point there is the CPI doesn't tell you the full story when it comes to what real experiences are. And if the official statistics are underreporting, it's even worse.
Exactly. Now, this is one I thought was quite interesting, especially when you contrast it with that of the US, because in the US, you've seen both junk bonds and investment grade bonds perform very, very strongly, mostly arguably due to the Fed and just demand for that type of both repo collateral and also just wanting decent sort of protection against potential downturns. But this is what makes the Chinese bonds so interesting, because they are displaying the classic signs of bond market stress. They're displaying, you're seeing that divergence between junk bonds, which are in blue, and the investment grade, which is like good grade corporate credit and government bonds. And you're seeing obviously they're performing very, very, very differently up until recently. So you are starting to see that bit of risk starting to creep into the investment grade bond markets in China and to be honest, across emerging markets.
And that's very interesting, Tarek, because I did notice that people like BlackRock are talking about buying back in, because a lot of those securities have dropped in value significantly, and saying, well, maybe there's some upside there as well. So the speculation continues.
Yeah, and I imagine it's likely to do so. You've got, Chinese stocks are, if you look at sort of ratios between the, Chinese and US markets, or even China and other emerging markets, they do look cheap. But by the same token, you don't know what Xi is going to take his sights to next, and what's going to be the next target of a CCP crackdown, particularly if they have a large bill to bail out the property sector. That money is going to need to come from somewhere.
And the fact of the matter is, Xi is going to protect the Chinese economy. He's not too worried about the international investors.
Well, exactly. If anything, him holding the international investors' feet to the fire might be of a political gain to him, and I think that that's something that Wall Street and investors more broadly need to keep in mind. Now, this is the problem for Australia, in that if this trend continues, Chinese steel production has absolutely plummeted. If you actually look at the long-term chart on this, it is the biggest fall in Chinese steel production on record. Now, I'm not sure if that goes back to Mao's Great Leap Forward. I imagine it doesn't, because that, everyone knows that ended very, very poorly. But it just goes to show just how vulnerable Australia is if China does decide to move away from this residential construction-led economy. And that's actually exactly what the People's Bank of China and the Chinese banking regulator said yesterday, that residential property should not be used as an investment or as a form of government stimulus.
RBA, federal government, please note.
Yeah, pretty much. If this is to be a long-term trend, then we have a fairly significant problem, because you are going to, obviously there's going to be a bit of a cushioning effect in the price of iron ore by the marginal producers being driven out. But, I don't think that the sort of $55 a ton that's penciled in on the federal budget is out of the question if these trends continue. But whether they will or not is the multi-trillion-dollar question.
And you can add to that, of course, the question of coal prices, because, of course, with the energy problem in China now, they're driving those prices a lot higher. So that might give us a little bit of a counter-cyclical move.
Well, I think that, someone made the point to me on Twitter the other day that is probably one of the factors supporting the Australian dollar at the moment. Otherwise, it would probably be significantly lower. And I think that's probably a pretty good theory. And I think that we may even see coal prices go higher if Europe and the rest of the Northern Hemisphere gets a very cold winter, because, at the moment, I read the other day that EU stocks of coal at power stations is, near decade lows. So, they've got quite a major problem going on, and that only further adds to the stagflationary forces. This is one of the Chinese. This is the official National Bureau of Statistics from China, so it's directly from the horse's mouth, so to speak, and it shows manufacturing export orders versus the US ISM manufacturing PMI. And it basically just shows that where the Chinese manufacturing sector leads, the rest of the world tends to follow. Now, this could be because China has generally, since the GFC, been the driver of marginal global growth, or it's just the fact that the Chinese manufacturing sector is the canary in the coal mine, so to speak. But it does raise some rather interesting questions, because new export orders have fallen back into contraction for the first time since the pandemic really kicked off in China, and that is a bit of a concerning sign considering the other problems going on in the Chinese economy.
Yeah. Well, wherever you look, the Chinese economy is definitely asking serious questions, not just domestically, though, of course, because of those flow-on effects internationally. And I'm not sure whether the markets have really woken up fully yet to just how big those risks are.
No, I concur. I think that especially here in Australia, I don't think that these things have been priced in. And I think there are other issues as well, to be honest, that have been really sort of glossed over by the stimulus efforts and by the closed borders that are going to come home to roost. Because in the next, apparently, we could be seeing Australians going off on holiday overseas as early as November. And whether ends up being the case or not, we'll just have to see. But if that does start occurring, we're not going to see these boosts to regional tourism and tourism in general here in Australia, because everyone's gone nearly 2 years without an overseas holiday. So that trip to Thailand or Bali or wherever it is that you prefer to go are looking going to be looking pretty attractive for this holiday season and into the new year. But the problem is are we going to have the tourists to come here and spend to replace them? And I have some pretty serious questions about that, particularly given that Chinese tourists are the largest demographic coming here, and they spend something like $12.7 billion a year. And I think you can be fairly certain that the Chinese government is going to be, sort of at the very least, very gently telling them, go somewhere else because we've got a problem with Australia.
And I'll also add that some further data I've seen this week, which is sort of private data, shows that there's more exiting of Chinese property owners in Australia, and they're taking money offshore as well. So if that continues, that's going to be another negative too.
Well, exactly. I mean, if you do see the sort of, the contagion, or even just a bit of belt tightening in China, you could see the Chinese citizens just selling off Australian assets because, particularly if we do see a push from the Chinese government to sort of try their best to insulate China, try their best to sort of minimize net capital outflows if things do go a bit pear-shaped. Well, the best way to minimize net capital outflows is to get some capital inflows. And the easiest and most political viable way to do that is to tell the Chinese to sell their offshore assets, particularly in places like Australia where we like to piss them off.
Just a bit.
Yeah. I think that's actually no. This is actually I believe this is the last one, but this is an interesting one because we haven't really seen it explored as of yet how much the rising cost of energy is going to impact nations economically. I mean, obviously we've seen some data and some estimates based on the closure and limitations on power in China, but the cost of gas in Europe has risen to, I believe Goldman said yesterday that it's around about the equivalent of oil at $200 a barrel. So it's absolutely taken off into the stratosphere, and that is really going to put a crimp on spending and on confidence more broadly. And this is some estimates from Rabobank that show that even on a GDP basis, that it's going to lop about 0.7% off Eurozone GDP. So personally, I think that the impact could be even more significant than that. It just if it really starts to undermine confidence, if the inflation narrative really starts to kick off, particularly in Southern Europe, it could start really creating some rather significant problems. And there's also the German factor as well, because they are culturally very, very hawkish on inflation.
Absolutely right. And it's interesting that the most recent missives out of the ECB were very, very sanguine about this. No, nothing to see here, no. But actually, it's pretty serious. And if you look at the UK, for example, where the gas prices went very high, that stopped two very important factories producing CO2. Those CO2 was actually used for things like dealing with dispatching pigs and chickens, and when at the end of their sort of growth period, right before they turned into meat, and so suddenly they realised that was a big problem. And also another example, CO2 is also used in the manufacturing and protection of goods in the supermarkets. For example, green lettuces and things, and that you put in a airtight, and then you throw CO2 in to keep them from going off. So basically, wherever you look, all these interconnections start to actually play on each other, to say nothing then, of course, of all of the questions around fuel and the fuel crisis and the queues and all of those things. It's wherever you look, you can just see all of these things being dislocated.
It sort of reminds me a little bit of, with the issues of globalization, it sort of reminds me a little bit of the way things were in 1914 after the outbreak of the First World War, because you had these interconnected, globalized supply chains, and then all of a sudden they ceased to exist, and everything needed to be jammed into a convoy, or everything needed to be prioritized for military usage, and you end up with these rather major issues. And one thing I think is really interesting as well, particularly about this gas issue, is that it's causing the closure of fertilizer manufacturing plants. And that's a really major issue. It's already caused the closure of two in Britain and one in Germany. And there are more, and there are apparently more potentially to come, as particularly as gas prices rise, because it's no longer viable. But the problem with fertilizer prices and fertilizer in general is, if you start having a shortage of fertilizer, the price of fertilizer is going to go through the roof, and then the cost of food will also feel upward pressure, and that's something that we're going to feel here in Australia if it does occur, and it's going to be felt around the world. And really, it's that food inflation, it's that impulse that you feel at the market when you look at how much money is left in your hands after buying your weekly groceries, and you go, oh wow, am I going to have enough to live? Is this going to be enough for me to really kick on and to have a good life, or is this going to be like a really, really major problem for me and my family and for my household? And that's something that's squeezed developing nations and their governments time and time again. And one of my major concerns in all this is that we do see a sort of long period of social unrest and economic crisis as a result of these inflationary pressures.
It's certainly possible, and it's interesting. The local supermarket here for the last 2 weeks have had gaps on the shelves, and they basically are saying, well, supply chain disruption, etc. So nothing serious, but it is actually interesting just to watch the fallout in terms of what you can and what you can't get. So, for example, today there was no milk.
Well, that's something that that raises an important question in all of this, because how much worse a supply chain issue is going to get. The number of ships being delayed, the number of ships waiting outside major ports is, at least in the US, is headed towards even greater heights. There was an article in the Washington Post yesterday that said that warehouses were overflowing in a lot of places, and basically our supply chains just aren't ready for all of this. And you've seen that in the US and in particular in the UK.
Absolutely. Well, there are about 120,000 drivers short in the UK, and that's partly because of Brexit, and partly because, which means that the international drivers don't want to come now drive in the UK. But basically what it means is they don't have enough transport logistics facilities to be able to move fuel around and other things. So all these knock-on effects, I just think that a lot of the interconnectivity is not fully understood, and at a very simplistic level, everything from costs of transport, look at the container price, through to all the connectivity between different manufacturers and processes. This is a very complicated set of things going on, and if you start pulling at the strings, it might become unraveled, and if it starts coming unraveled too far, then the things that we take for granted just aren't there anymore.
I think the problem in all of this is that you can't fix these problems that we're talking about easily. They're very, very difficult problems to fix. They're very, very complex. It's not something that you can just throw money at it and solve it. You can't just magically create 120,000 lorry drivers in Britain. I suppose you could if you throw enough money at it. If you throw billions and billions and billions and get every lorry driver from everywhere else in the world to go there, I'm sure you could. But that's not really that viable. But it just goes to show that you can't solve these problems easily. And there is now even sort of major shipping companies saying that these logistics issues, these supply chain issues, are going to continue well into 2022. And I've heard some estimates of them continuing in some capacity for the rest of the decade. And I just think about it, and I believe it was one of the executives from Maersk. He came out recently and said that basically the only way that we're going to solve the supply chain issues is if demand comes off. So you end up with this sort of issue where you've got basically stagflation until it turns into deflation because there's no real way to balance the two.
Yes, and I was talking to someone the other day who's well across some of the shipping issues, and so there are queues of ships, not just in China but also in the US, waiting outside to get in the ports.
Yeah. I mean, you've got. I mean, I think they said even if things, basically just they were allowed to process the current backlog without any impact of further ships. I mean, I've heard estimates at LA and Long Beach of about a month just to process the ships that are already there, without the ones that are obviously going to come, to need to dock in the meantime. So, but the problem is, and one of the things that a lot of folks don't seem to understand, particularly on Wall Street, I must say, is that every month that they're sitting there off the coast of Long Beach is a month that they're not going around the world delivering stuff to everywhere else.
Yep.
Which then just, it's basically like the old hog passing through the snake, and so it just keeps going and going and going and going, and it ends up affecting everywhere else. So, these issues are not simple to solve. And not only that, but we're coming into the peak shopping season.
Yeah, absolutely. Well, there are dire warnings from the UK about Christmas won't be very good this year because there'll be nothing in the shops for people to buy. So it's pretty serious when you can't buy your Christmas crackers.
Well, it is. I mean, and that brings us back to what we talked about in our I believe it was our last chat or the one before that. You can't sell what you don't have, and what you don't have can't contribute to GDP or to the economy. And to me, it sort of blows my mind that you've got the Vice President of the United States telling Americans to get their Christmas shopping done early because of potential shortages, and then Wall Street's like, la 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 la, move along, nothing to see here.
Well, let's talk about Wall Street briefly, right? Because we got to the end of September, and the markets are down, but really not that much. Now there might be more falls ahead, possibly, but it is interesting looking at the dynamics of the market, right? We know that tech stocks have come off their highs. We know that some of the other things like China and Evergrande sort of came on and then went off again. I was reading an article just now suggesting that maybe Wall Street is underestimating the true impact of Evergrande. I think that's probably right. But you wonder whether they are just going around in their own little haze or whether they've actually got some superior insight. I'm afraid I think the former rather than the latter at the moment.
Yeah, I don't think that they have superior insight. I think that there are some analysts who do have some fantastic insights. I've used some of their graphs and charts in my slideshows on a regular basis. There are some people who I respect a great deal and bring a lot to the party. But I think more broadly in terms of the groupthink, I think that it's just optimism for the sake of optimism. And, I think that they're just once again not prepared for the downside. And I mean, I remember in early February last year, they were all like, oh, well, things are a problem, but look at the market. The market's doing okay. It's still rising. It still hasn't peaked yet. And then, about, 2 weeks later, it all just fell off a cliff. So, I think that there's a lot of risks there. But by the same token, we live in this world whereby, Jerome Powell and the Fed and Lagarde and Kuroda wave their magic wands, and then investors just turn into idiots who just can only hear the money printing. They don't. Nothing else matters. And I mean, I suppose I can't really blame them because it's been a rather successful strategy.
Well, it certainly has, because the markets are very high, and if you look at the growth over the last 12 months. But you've got to ask the question, can it go on? And just worth reflecting on this. The reverse repos in the US have gone even higher than previously, right? This is money that the banks can't lend, of throwing it back to the Fed. And of course, they recently upped the limits on what they could actually do as part of the reverse repos to try and... But, you've got to ask the question, all this funny money, it's not really it's not really doing anything productive. It's just going around the system, keeping the financial markets up.
Well, it's that, and I mean, as I've said previously, I think that QE is more psychological than it is, sort of technically providing a boost to markets. Because, if QE was so fantastic, the DAX and the FTSE would have gone to the moon. Years and years ago, and well, the Nikkei would have reached Mars by now. But it doesn't work like that. But one thing I've been thinking about with QE and with inflation and with all these different things is I've been actually sort of exploring some of the aspects of MMT. Now, here I go walking into the minefield. One of the things I've thought about this recently is perhaps what we may end up seeing if we do see these protracted, serious inflationary pressures is as something whereby we see rising rates to, because basically that's the only thing they can do, because, if the only tool you have is a hammer, every problem looks like a nail. But perhaps what we'll see is central banks continuing to monetize debt through QE in order to basically avoid a sovereign default, avoid a sovereign debt crisis, yet allow some form of, a disleveraging or deleveraging of the private sector. Because we can't keep going on like this forever. Eventually we will come to an impasse, and I do wonder what happens there. I'd be interested to hear your thoughts on that.
Well, I've been saying for some time that quantitative easing can't go on forever, except that they keep doing it and doing more and more and more of it, right? And actually, it's not linear, right? You have to actually logarithmically do more of it to have an effect. And if you just think about how much money has been thrown around the world and how little return it's got in terms of growth and outcomes, you've got to say, what's the chances of, if they do a bit more, anything different from what we've got at the moment? Probably not. It's probably going to go on the same. But I would remind you what that recent report from the House of Lords said with regard to quantitative easing. Their conclusion was quantitative easing, however it's dressed up, was all about just keeping the interest rates for government debt ultra low.
Yep.
Because if rates were to go up, that would effectively bust budgets left, right and centre. So it is actually simply about rate control. That's all it's about, really.
Well, that's why I wonder if we could see sort of an RBA-style monetization of, big pusher towards the monetization of debt, because, obviously it's only a theory, but I just wonder if they are just going to take the Bank of England sort of, findings and then just turn it up to 11, because, that's basically what they did in 2020. They turned it up to 11, and then it's just like, well, let's turn it up to 11 again, to an even greater level, or 111.
It's 111, exactly. Well, but there is no theoretical limit to what they can do, right? They can go on essentially issuing debt and then buying debt. Those things, because you're lifting both sides up, they can do that ad infinitum. Mm. The question is, will it actually have any different impact other than what it's had so far? And that for me is the really interesting question. And tell it not too loudly, but actually there is really a very strong strand of MMT already happening.
Yeah, there is. Mm. Although one thing on the sort of topic of MMT, QE, and all that sort of thing, one thing I thought was really interesting is in the US we're starting to see a bit of political pushback on that. Mm. We're starting to see, the likes of, Joe Manchin and stuff like that, who is basically, you'd probably call him the de facto president in terms of actually passing legislation on Capitol Hill. And he's saying, basically the Fed needs to end QE because it's causing too much inflation. Now, I disagree with him that it's the main driver of inflation, but at the end of the day, you've got to blame someone, and the politicians aren't going to blame themselves.
No, absolutely. Well, it's interesting that, of course, they'll always point to somebody else, and conveniently, the central bank, of course, has responsibility for it. So, of course, it's their fault. The central bank, on the other hand, would say, well, if you'd done what you should have done as a government, and done things differently, we wouldn't have had to have taken the rates to where we took them. So, there's one of those really interesting impasses. And it's interesting because, what's the relationship between central bank and federal government here or over there, right? They're actually quite close, but they're like yin and yang, right? They're the two halves of the same problem.
Well, they are, but then they both say, when something bad happens, they both say it's not my fault. It's the other person's fault. Mm. When the central bank creates problems with, housing prices, they say, oh, no, it's not our fault. It's the government's fault. The government should have done things differently. They should have, managed the economy better, because that way we wouldn't have had to cut rates the way we did. Mm. And then obviously the government will pass the buck and say, oh, well, no, it was rates, or it was insufficient supply from the states or the councils or whatever. It's all, It's always someone else's fault. I mean, what I want to do is I just want to get Scott Morrison, Philip Lowe, Wayne Byers all in the same room. Might as well include all the premiers and the chief ministers as well, and just go, okay, which one of you is responsible for housing prices? Once and for all, just pick a class of you, please.
Yeah, well, that's right. So we come back to Australia, of course. There's a couple of interesting things this week, right? Firstly, of course, Frydenberg came out and said, oh, maybe it would be a good idea to actually bring in some macroprudential controls, right? This is the guy who 3 months ago was arguing very strongly for the removal of responsible lending obligations.
Well, my question is why? Why is he doing this? I understand, obviously, housing prices are out of control and, from a sort of dispassionate perspective, something needs to be done about that. But by the same token, this is the same guy who basically completely ignored the major recommendations of the Royal Commission. And he was also treasurer at the time when APRA gutted the serviceability ratios, which is one of the main reasons why housing prices set off for the moon anyway. So, yeah. I mean, I don't think you really get that much credit for basically, running around the neighborhood with a flamethrower and then putting out part of the fire.
Oh, it's been done. But, I've got this theory that, think about, play this forward, right? Who's going to be the next potential prime minister, assuming that the Conservative side of politics gets back? Yeah, well, it's probably, now that Porter is basically, had all his problems. And I think that, he may be terminal in terms of a sort of making a case for the leadership. It'd be pretty tough to come back from this. Especially considering the fact that whenever anything comes up again, Labor's just going to be like, well, I didn't get $1 million from some random benefactor, did you? But, realistically, Frydenberg is probably the main sort of centrist candidate. I mean, it's bizarre to call Frydenberg a centrist considering, the wrecking ball that, through banking regulations. But, it's either him or Dutton, really, in terms of like the major players, unless we see, sort of a dark horse emerge, but or someone transplanted from state politics. I think that's always a possibility, particularly if ScoMo gets hammered and they want sort of a fresh, moderate face. But yeah, I think it's interesting. Although just on a very specific Josh Frydenberg level, he may have some problems in Kooyong coming up. There is quite a substantial effort to unseat him. There's quite a bit of money behind it too. So perhaps, it's a bit of self-preservation on his part. I know that's why the Liberals are moving towards a more comprehensive climate change policy. I always say to people, folks, remember that the one thing that you can bet is that a politician will try and do the things to get re-elected, right? Never mind what that is, never mind what the policies are, the end goal is just to get re-elected.
Yeah, well, it's a bit of a riff on the old Winston Churchill quote about Americans. They always do the right thing after every other option's been exhausted.
That's a lovely quote, that, isn't it? Oh, great. So it'd be interesting to see. And of course, APRA came out then and said, "Well, yes, we'll perhaps put a paper together." But did you notice in the Council of Financial Regulators minutes, it was a really interesting, didn't say much, but what they said was that APRA is going to consult the Council of Financial Regulators.
No, I didn't see that.
Yeah, just think about this. Who are the members of the Council of Financial Regulators? RBA, APRA, ASIC, Treasury, right?
Yeah.
So basically, APRA is going to consult itself about macroprudential policy. This is just weird.
Yeah, I suppose in a way it's variations on the theme of the way that the current government operates. It's all, if you govern by committee and focus group and opinion polling, then you can't really go wrong. And if you do go wrong, you can always blame someone else. And I suppose that's what perhaps that's what APRA is doing in this instance. I don't know. It's just it is interesting. Although perhaps it's just a way of by going through the Council of Financial Regulators, it's just a way of delaying the implementation of these things. Of saying, oh well, we've got to go through this committee and that committee and have this discussion and
they're going to put out a paper in a couple of months, is what they said.
Well, I think in a way it's sort of funny because if we do see an election later this year or early next, for Morrison to capitalise on, reopening borders, vaccine targets being hit, etc., it would be nice for the government to be able to point to this and go, "Oh, look at this. We're working on this. We fully intend to help people. We're working with the Council of Financial Regulators to improve housing affordability. Aren't we fantastic?" And then they could keep it on the merry-go-round until after the next election, and then go, "Oh, yeah, we'll just tinker around the edges."
And of course, there's also the current inquiry on housing supply, right? Housing affordability and supply, right? Funny that.
Oh God, I've been reading these papers for a long, long time. I've read some of these papers, these Senate papers, Senate minutes, going back literal decades. There was an inquiry, I believe, in 2008, 2009, a Senate inquiry into housing affordability and the impact of housing affordability on the community. And it basically concluded that housing affordability and the ability for a household to put down roots, to have a family, to get involved in the community was incredibly important on a personal level, on an economic level, and on a social level. And then they took all that, looked at all those findings, and then completely ignored it for the next 12 years. Yep. So I have absolutely no confidence whatsoever that they're actually going to make moves to address these problems, because they didn't then. I mean, honestly, sometimes I just wish that Rudd just let the whole bloody thing crash and just, we just got on with it, I can only imagine how much better off we'd be with all this, all this extra capital dedicated towards business and investment and not houses.
But you see, it's interesting because there have been about 6 inquiries on housing and those things over the last about 15 years, I think, the last time I counted, right? I mean, I've put similar submissions into most of them because, I might just dust it down and change the numbers a bit, because it's basically the same problem. You cannot solve this by just looking at supply side things. You cannot, unless you understand that credit availability is the most critical lever. And, if you take interest rates really low and if you reduce lending standards, guess what? People can borrow more. That means they push house prices up. That's the problem. But nobody wants to admit that. So they'll go back to their default position, which is it's all the state's problem. Lack of supply, despite the fact there's more property than we need at the moment by about 1.2 million properties, according to the ABS surveys that I saw some time back. We are actually not wanting to tackle the critical issue, because if we did, it would actually fundamentally deal with credit availability in the banks, and those are sacred cows that nobody wants to touch.
Okay, forgive me, audience and Martin, if this turns into a little bit of a rant, so I'll just, sort of warn you right now. But part of the problem is that if Australia suddenly reverted to, say, a mid-1990s way of approaching its mortgages in terms of paying them down rather than drawing cash out, the economy would faceplant in short order. You'd be pulling a roughly sort of 15%, 16% of disposable income out like that, because that is what drives this economy, for better or worse. So basically, you can't get rid of rising housing prices and not have serious pain from that perspective. And that's not even that's just the effect in terms of the actual money flowing in and out of equity, mate. But in terms of the impact on confidence, in terms of asset holders going out to Harvey Norman because they feel wealthier, that hasn't yet been quantified. But the thing that gets me about all of this is Philip Lowe and the rest of the central bankers. They say, "Oh no, but it's okay because in aggregate people are spending more. In aggregate there are more jobs." But all I can say is, as a member of the generation who has been forced to deal with this, get stuffed. Because we are the ones who have to pay for it. We're the ones who are going to have to pay the taxes, and not only that, but you're all paying the taxes on it for it right now to prop it all up, and the burden is being placed on non-home owning households, and that is absolutely insane. But they say, "Oh, but because in aggregate things are better, then you should be fine with that." Well, it's like, well, no, actually, we're not okay with that. We're not okay with the fact that people are now buying their first home at closer to 40 than 30. And I can only imagine how much that's degraded since the last statistics were released. And then they go, "Oh, but why aren't people having children?" It's like, oh, I wonder. It's because they don't have any money, because they're saving for a house.
Absolutely. Well, the fact is, This is going to be coming off my long run a little bit. The fact is that we've got a situation that has been created over 30 years of stupid policy, right? And every time they just turn the wick up a bit more and a bit more and a bit more, which means that essentially more and more people have to put more of their income in to be able to get that house if they want to buy it, right? But the problem is that the aggregate average, which is what the RBA often quotes, masks these massive differences, right? It's worth just reflecting that we've got 1/3 of homeowners mortgaged, another third of households who own their property outright, and a big third renting. And in fact, of the two, the one that's actually shrunk is the people who own their property outright. The two that have grown are actually those with a mortgage, but the one that's grown the most is people who are renting because they can't get in the first place. So in terms of actually a top-level metric of success, complete failure, right? Second point is the RBA claims that households are doing fine on their finances, right? They're using data which is 3 years old from Hilda. That was pre-COVID, right? And it was already out of date then. And they're using data from the securitized mortgage pools, which are pools of mortgages specifically hand-picked to have certain characteristics to be able to actually sell them to investors. They are not actually basing their information, I think, on robust, reliable and current sources when they make the claims that they make. And yet they keep claiming there's nothing to see here, right? And yet all my data is saying, no, this is a really, really big problem because we've got a lot of people absolutely stuffed at the moment in terms of cash flow because they're trying to keep those mortgage payments going while incomes are going down and cost of living are rising. The risk, of course, of interest rates going up may be there in the future. And then, of course, everybody says, well, now what we must do is we must stop some of these high debt to income and loan to value ratio loans. So new borrowers, well, we'll trim that back. But what about all those people who've borrowed over the last 2 or 3 years at these very high multiples with very high levels of exposure? And what are they going to do? Because incomes aren't going to grow anytime soon.
Well, exactly. I mean, what really gets me is, I've done a bit of the math into this, is what's going to happen to all these people who've bought homes in the last, say 18 months on these low fixed rate mortgages. They've bought these homes at 1.79, 1.89% mortgages. And, some of the variable rates on these things are pushing 4 and a bit percent. So people's expense on interest is going to more than double overnight for these people. And, not only that, but if when the fixed rate mortgage ends, rates have risen, let's just say even it's only like a pedestrian 1.5%, which is, sort of not a historically huge move, based over the last, say, 30 years. What are they going to do? I mean, you're going to have your interest rate go from 1.89 or 1.79 to like 5.5%. I mean, we're going to find out very quickly how accurate our serviceability ratios are. I mean, we'll see about that. But, there's the thing that gets me is like if we had 30-year fixed rate mortgages, I could sort of understand the access to it to a certain degree because it's like it doesn't really matter. The price is never going to go up. And, if you've got a scrimp and save over time, you could probably, have a better chance at making it work. But considering the fact that our mortgages are at the mercy of 90-day to 3-year bank funding costs, I don't know what the next 5 years is going to hold. I don't think anybody does. No,
well, I think it's going to be a very uncertain period, and it may well be that rates will go higher. But the other point to make, Tarek, is of course CoreLogic came out today and said house prices have boomed. Well, some have. But the other day I did a post, somebody asked me on Twitter, saying basically, well, I won't believe that house prices are anything other than booming until I see evidence. So I threw out some evidence, right? I took the unit prices for North Ryde and showed that they were down 26% from where they were in 2017 now, right? And the response was, well, you're cherry picking. I said, well, okay, let's look at another one. So I went to Parramatta, and Parramatta units are down, right, 6 or 7% from where they were. The point there is what's gone up are standalone houses in certain locations dramatically, right? But a lot of other prices, particularly for high-rise apartments, are down. And again, that's not going to be reported anywhere. So effectively, you've got this complete distortion of the truth in terms of the way that the information is being reported at the moment, right? And I would argue that the Reserve Bank and APRA and a lot of other people are being very picky with some of the information they're sharing and not actually giving a very representative picture as to what's really going on.
I mean, I never thought I'd say this, but here we go. I actually think that the RBA need to take a leaf out of the book of the People's Bank of China and tell people that housing is not for speculation. It's not meant to be used as a government. Housing construction is not meant to be used as a government tool to stimulate the economy. It's meant for living.
Yeah.
Shockingly enough. Now, I just want to clarify that just before anybody jumps down my throat. I don't care that you invest in property. Go for it. That's, I mean, if I was in a different time and things were a different price, I'd probably strongly consider it myself. But I don't think that we should be living in a world where property investment is as incentivized as it is by government policy, by monetary policy, and by macroprudential policy. We should have a focus first on our society, on getting people into a home, on having a family, on having a life, on sort of contributing. I mean, on aggregate, if you want to sort of purely get it down to a dollar number, contributing to the economy. But you can't do that if you're spending 15 years saving your pennies just to get a 20% deposit together. So, I think that we really need to have a broader discussion about that. And to be completely frank, one of the things that gets me in all this is it's just like, well, it's all a case of in aggregate. But it's like, in aggregate, we're killing the economy with this.
Yes.
And that is what we need to focus on, not just the short-term sugar hit. Because without taking rates negative, there are no more sugar hits. Okay, we'll get rising prices until they reach equilibrium with rates, probably sometime in the next 12 to 18 months. But what happens after that? It's just so short-sighted. But I mean, that's the world over now, isn't it? I mean, I would have, last year I probably would have said something along the lines of, this is, Australia, and a few other select nations. But I mean, pretty much the whole world has, followed this path, hook, line, and sinker.
Well, absolutely. So in my submission to that inquiry I mentioned earlier on, I went through all of those arguments and basically said 2 points. One is, I think that housing and access to housing is a human right. It shouldn't be it shouldn't be based on frankly just investment markets, right? But the second is, and I quoted, I think it was an IMF piece of work that was done some years ago, basically saying the biggest risk around the world is the financialization of property, right? Where property has become a financial asset, it's seen just as a financial asset, it's seen as a speculative asset, and that means that basically you cannot see it as what it is, which is it should be a place to live and to put down roots and those sorts of things. So unless you tackle financialization, right, and unless you actually understand that provision of somewhere to live should be a human right, you're never going to get this right.
Well, no. I mean, one of the things I think is interesting at the moment with the, housing as a place to live and, movement in China and common prosperity and all that from the Chinese government and, President Xi, is that Chinese real estate is the single largest asset class on the face of the planet. It's worth $60 trillion. It's worth more than the entire US stock market and, quite a few other stock markets all together combined. I mean, hell, it's even worth more than Aussie property. And the thing is that, we are going to get a lesson on this in the next couple of years, because either A, Xi and the Chinese government will balk and they'll just end up going back to what they've always done, which is more construction-fueled stimulus. But if they choose B, which is what some people who understand the situation much better than I do are suggesting they may, if they sort of, if they tweak the Chinese property sector, if they sort of pull away from that, they allow prices to fall. One, it's only a matter of time before Chinese here sell their properties because they need cash, because they've over-leveraged themselves on property at China at up to something like 46 times household income. Or, and then it just raises that question of like, well, what happens then? I mean, Australia has bet our property on their property. Because if they do pull back, if we do see some of these these situations and these scenarios put forward by the likes of, say, Goldman realized, and we do see Chinese housing starts fall 15 to 30%, as has been suggested, well, iron ore is going to get whacked, coking coal is going to get whacked, and then when coal prices finally return to earth, once it starts to warm up after the northern hemisphere winter, I imagine thermal coal prices will get whacked. So, we've really just bet the farm. We haven't even bet the farm on Aussie property. We've bet the farm on Chinese property.
Absolutely. Well, it's interesting because Harry Dent, who I've had on my show a few times, makes that exact point, that actually the whole world is basically dependent now on what China does, right? So if China sneezes, right, we're going to catch them almighty cold, and it's going to be probably related if it goes wrong, and of course that will have a spillover effect. I think he's probably onto something there. They may well try and stop the rot this time, but if they do stop the rot, the other thing to ask locally here is how much higher will property prices grow, because you need to actually continue this rate of growth to try and actually continue to grow the momentum in the economy, right? So, $1 million, $2 million, $5 million for, 2 up, 2 down in the outskirts of Sydney. I mean, where's the limit?
Well, my question in all of this is that if we do see further stimulus, on a large scale, whether it's from China or Europe or America, is what exactly is going to happen with inflation? The Bloomberg Commodity Price Index is currently already near record highs. Now, people say, but China can just stimulate. They can just do what they did last time, what they did in 2015, 2016, what they did in 2008. They'll just do that all over again. But what is really lost in all this is look at where iron ore prices and commodity prices were in 2008 and again in 2015, 2016. They got smashed, particularly in 2008.
Yep.
So you can't just go, we're just going to throw some more money at it. If the Americans throw more money at stimulus at households, all that's going to happen is the supply chain issues are going to get even worse. And inflation's going to get even worse as a result, as you see, the bottlenecks basically get jammed up with even greater amounts of good and greater amounts of capital. But the problem for China is that if they throw the kitchen sink at stimulus, iron ore prices are going to go to the moon. Coking coal prices are going to go to the moon. Copper, all these industrial metals that are used in construction are going to go into the stratosphere, and that is going to set off a wave of inflation in China, which could potentially end up threatening CCP rule. And that's something that Xi really doesn't want, because he had a very, very difficult time during the Cultural Revolution, and he's seen what social unrest it does. Now, not to put too fine a point on it, but when his family was ostracized and attacked during the Cultural Revolution, it drove his sister to suicide. And this had a very, very serious impact on Xi's psyche from what insiders have had to say. So, that is something that he is genuinely concerned about. That is something that he doesn't want to repeat, which is why it makes the idea of further Chinese stimulus on this grand scale very, very challenging, to say the least, if not outright improbable, if not outright impossible.
Right, and if you add to that the focus on what's right for China, not necessarily what's right for other places, right? They're going to focus on what's right for them. The chances are more likely, I think, that we will see weakness, and that weakness will spread. Now that will be very interesting coming up against, the COVID thing is still not fixed. The supply chain bottlenecks, the quantitative easing programs, right? And so, in a way, going back to your title of the show, you got these different worlds, but actually they're colliding and on the same basis.
They are, and part of the problem in all of this as well is, like I said in the slideshow, is that on an aggregate basis, you've got people like Josh Frydenberg saying, but we have $220 billion in excess savings, or we have X amount of GDP growth, or we have Y amount of an improvement in the budget. But that doesn't tell you what's going on the ground. And it doesn't tell you how households are going to tighten their belts if we do see these inflationary pressures starting to push through. I mean, I'm not sure if you saw the other day, the ANZ Inflation Expectations Index is at its highest level in 7 years.
Yep.
And we've only just seen the beginning of inflationary pressures here in Australia from what I've heard from people in manufacturing and shipping and wholesaling.
Absolutely. And then, of course, the bottom line question is, if inflation is real and it's going to run through, can the Reserve Bank keep rates as low as they currently are? because if they have to start putting rates up, then it's all over Red Rover, isn't it?
I do sort of wonder how that will play out over, in the sort of early parts of that potential scenario, because they do have a fair bit of room between where they are and variable rates. Variable rate, the average variable rate is still quite high. It's still in the, what last time I checked it was about 3.7. Is that about ballpark, Martin?
Yeah, it's new ones are a bit lower, but a lot of people aren't on the latest rates, right?
Yeah, but like existing rates about 3.7-ish.
Yeah, it's a reasonable middle of the road, yeah.
Yeah, so, there's a fair bit of room in terms of that, in terms of net interest margins, but in terms of these low rate fixed term loans, these 3-year loans at sub 2%, sub 2.5%, depending on, your individual position, deposits, etc. It's entirely possible if we see the 3-year bond yields rise, further, that they could cease to exist.
Yeah, and if you just wind the tape back to the global financial crisis just before it, right? What was the thing that killed the US property market and the US banks? It was those low rate, adjustable rate loans, right? And then they suddenly went up, right?
Yep.
It wasn't the whole market, but it was enough of the market to actually create significant contagion. And from there, things fell over. And we've built our same problem here, with all of those low rate mortgages that people are currently sitting on at the moment. Now, most of them are, 3 years or maybe even 5 years. But there is going to be a point where, as you say, they'll have to actually move on to something else. And my suspicion is those rates will be higher. So another reason why people will be hunkering down and thinking about, saving rather than spending.
Well, I think what we need to do is to do a survey of Australian strippers and determine how many investment properties they own and how many they own on average, and that way we can determine when exactly our big short moment will occur.
Hey, okay, we should create a new index called the stripper index, right?
Yeah, I think that might cause a little bit of what's this? So, I can just imagine, the missus coming in and going, stripper index, what are you looking at?
But no, it is. And I actually watched The Big Short again the other week, right? I do, it is so insightful in terms of understanding the psychology. Because, at the end of the day, I've spoken this before, but maybe this is a good place to sort of wrap up today. It's all about psychology at the end of the day. It's not really about economics. It's not actually about, numbers. It's about how people behave, how people will behave, and what drives them to behave the way they do.
Yeah, it is. And whether you're looking at QE or whether you're looking at property or whether you're just looking at, the stock market more broadly, it is all about confidence. It's all about narratives. And as long as those narratives persist and as long as they remain ballpark accurate, even if there are, these issues like the ones that you've mentioned in terms of, selected areas or selected industries, as long as they remain broadly accurate, they can remain in place for a lot longer than you and I would probably like, and a lot longer than a lot of people expect. So, that I think is the takeaway in all of this is that, yes, are there problems? Absolutely. There are, legions of issues across the world, but when the market will wake up to them and when, the economy even will wake up to them and when people more broadly will start to become aware of them is a whole nother kettle of fish. And you sort of get the feeling that we will see some challenges and stuff like that in the relatively short order, but when exactly that's going to become a problem for the everyman and they're all going to take notice is, a whole nother matter.
No, I prefer to watch the footy and go down to the beach and she'll be right.
Well, the problem is she'll be right has not only worked relatively well, but it's seen some enormous gains for basically doing nothing but being born at the right time and buying in the right area. I was talking to a friend the other day who lives on the northern beaches. They bought their house 10 years ago and it's worth 3 times what they paid for it. Just because they bought in the right place at the right time.
Timing is everything, Tarek. Timing is everything. Well, we've run out of time today, but I appreciate your insights once again, and always enjoy exploring them with you. We didn't have a chance to talk about Turnbull and his long run relating to subs, so maybe we'll have to do that another time, eh?
Yeah, no worries. I'm sure it'll all blow up again at some point in the media, so we can do it then.
Thanks very much. See you soon. Bye bye.
No worries, mate. Bye.